Right now, as you're watching this video, there's money sitting in your bank account that you believe is safe. You trust it's protected. You probably think that if you wanted to walk into your bank tomorrow and withdraw every single penny, you could do it without any issues. But here's a startling thought. What if you couldn't? Not because your bank would stop you specifically, but because if everyone tried to do it at the same time, our entire financial system could face a massive shock. This isn't just some far-off theory anymore. There are economic indicators flashing right now, in 2025, that some analysts are comparing to the period right before the historic crash of 1929. The parallels are striking, but with a crucial twist. This time, it's different. This time, our money isn't just held in physical bank vaults. It's woven into a complex digital web of algorithms, global regulations, and financial instruments so intricate that their behavior under extreme stress is a huge unknown. So today we're going to explore why your savings might be in a more delicate position than ever before. We'll examine the similarities and differences between today's economy and the lead-up to the Great Depression. By the end of this video, you will grasp a critical concept that many might overlook until it's just too late. The nature of financial crises is changing. If another one were to happen, it wouldn't be a replay of 1929. It would likely be faster, more complex, and unfold in ways we've never seen before. Let's dive in and understand what's really going on. The story of the Great Depression often starts with Black Tuesday in 1929, but the cracks were forming long before that. There was widespread speculation, easy credit, and the belief that the stock market could only go up. Sound familiar? Today, we see similar patterns, but amplified by modern technology. We have instant trades, algorithmic investing, and global markets that are connected 24/7. This speed means that while opportunities can multiply quickly, so can risks. A tremor in one market can become a global earthquake in a matter of hours, not weeks. One of the biggest differences between then and now is the sheer complexity. Back then, your money was in a bank. Simple. Now it's part of a global chain. Banks invest your deposits in various assets, from government bonds to complex derivatives. This system is designed for efficiency, but it also creates interconnected risks. A problem in one part of the world can trigger a domino effect that reaches your local bank in unexpected ways. It's not about a bank run in your town. It's about a digital contagion that can spread silently and instantly. So what does this mean for you and your savings? It means the old rules for protecting your wealth might not be enough. The idea of simply keeping your money in a safe savings account needs a second look. We're not talking about panic, but about preparation and understanding. In the digital age, financial literacy is more important than ever. Knowing where your money is, how it's being used, and the risks involved is the first step toward building real financial resilience. The next crisis won't be announced with a newspaper headline. It'll show up as a notification on your phone. Are you prepared to understand what it means? Let me ask you a question. How much money do you think your bank actually has? I mean, if you have $10,000 in your checking account, do you think there's really $10,000 sitting somewhere with your name on it? Maybe in a vault? Or on some secure digital ledger? The answer is no. Not even close. Right now, your bank has about 10 cents for every dollar you think you own. Some banks have even less. This is called fractional reserve banking, and it's been the foundation of our financial system for over a century. But here's what makes it both fascinating and terrifying at the same time. The system only works as long as everyone pretends it works. Think about it like this. Imagine you and 9 friends each give me $100 to hold on to for safekeeping. I promise I'll give it back whenever you ask. But instead of keeping your $1,000 in a safe, I keep just $100 in cash and loan out the other $900 to someone else. As long as you and your friends do and all ask for your money back at the same time, everything's fine. I can pay whoever asks, and I'm even making a little money on the loans. But the second you all want your money back, I'm finished. I only have $100. The system collapses instantly. This is exactly how your bank operates every single day. And for the most part, it works. People deposit money, people withdraw money, and the flow stays relatively balanced. The banks make their profit from the difference, and the world keeps spinning. But in 1929, something changed. People stopped pretending. And when that illusion shattered, the entire economy came down with it. The Great Depression didn't really start with the stock market crash on October 29, 1929, Black Tuesday. That's the date everyone remembers, but the real devastation came in the months and years that followed, when regular people realized their money wasn't safe. Picture this. It's December 1930. You're a factory worker in Chicago. You've been hearing rumors that banks are failing. You've read about people losing their life savings overnight. One day, you hear that the bank 2 neighborhoods over just closed its doors. Permanently, thousands of people lost everything. So what do? You go to your bank right now. You withdraw your money. All of it. And you're not the only one. Hundreds of people show up at the same bank on the same day, all demanding their deposits. This is called a bank run, and it's a death sentence for any financial institution. Here's the brutal math. The bank has your money on paper, but most of it has been loaned out to businesses, homeowners, and investors. Those loans can't be recalled instantly. The bank simply doesn't have the cash, so they close the doors. Lock them. They put up a sign that says they'll reopen when conditions improve. They never do. Between 1930 and 1933, over 9,000 banks failed in the United States. 9,000. People who had been financially secure lost their entire life savings in a matter of hours. There was no FDIC insurance back then. No government safety net. If your bank went under, your money simply vanished. The psychological impact was devastating. People stopped trusting banks entirely. They buried their money in backyards. They hid it in mattresses. They pulled back from spending because nobody knew who would be next. And when people stop spending, businesses collapse. When businesses collapse, unemployment skyrockets. When unemployment skyrockets, even more people can't pay their loans back to the banks, which causes more banks to fail. It's a death spiral. And once it starts, it's almost impossible to stop. By 1933, unemployment in America hit 25%. 1 in 4 people couldn't find work. Families starved. Shantytowns called Hoovervilles sprang up in every major city, named mockingly after President Herbert Hoover, who many blamed for the crisis. It took a world war and massive government intervention to finally pull the economy out of that pit. But the scars lasted for generations. So here's the billion-dollar question. Could it happen again? Most economists will tell you no. They'll point to all the safeguards we've put in place since the 1930s. The FDIC insures deposits up to $250,000. Central banks, like the Federal Reserve, can inject liquidity into the system to prevent bank runs. And governments can bail out failing institutions. But let's be honest. Those same economists didn't predict the 2008 financial crisis. They didn't see the collapse of Lehman Brothers coming. They didn't anticipate that the too-big-to-fail banks would need trillions in taxpayer-funded bailouts just to survive. And what's even more concerning is that they might be missing the warning signs right now, signs that suggest the next financial crisis could be just around the corner, and potentially worse than anything we've seen before. The system is more complex, more interconnected, and more leveraged than ever. The same fundamental principle of fractional reserve banking is still at its core, but now it's supercharged with complex derivatives, global debt, and digital speed. The illusion of stability is comforting, but history shows us that it's just that, an illusion. What happened in 1929 wasn't just a financial event. It was a crisis of belief. And belief, as we've seen, can be a very fragile thing. The tools we have today are designed to fight the last war, but what happens when the next crisis looks completely different? What happens when trust evaporates not in a matter of months, but in a matter of hours or even minutes, thanks to social media and instant digital transactions? The parallels between then and now are unsettling. We have soaring asset prices, record levels of debt, and a growing sense of unease among ordinary people that the system isn't working for them. Is it possible that the safeguards we rely on are just another layer of the same illusion? That we're just one major shock away from another 1929-style crisis of confidence? It's a chilling thought, and one we should all be considering. Let's fast forward to today. The world feels completely different than it did in 1929, right? We've got incredible technology, instant communication, sophisticated financial tools, and regulatory bodies watching every move. But here's an uncomfortable truth. All of that complexity might actually be making things worse, not better. I'm going to break down what's happening right now in 2025 that should have you paying very close attention. First, let's talk about the debt bomb. Global debt has exploded to levels that would have been unimaginable a century ago. We're talking over $300 trillion. That's more than 3 times the entire world's economic output. Governments, corporations, and individuals are all leveraged to the absolute brink. Back in 1929, debt was a problem, but it was containable. Today, it's systemic. Countries like Japan have debt-to-GDP ratios over 250%. The United States is approaching 130%. These aren't just numbers. They're ticking time bombs waiting to go off. Second, we have the everything bubble. Remember how the 1929 stock market crash triggered the Great Depression? Well, today we don't just have a stock market bubble. We have a bubble in stocks, bonds, real estate, cryptocurrency, private equity, you name it. Why? Because for the last 15 years, central banks have been printing money like there's no tomorrow. After the 2008 crisis, they kept interest rates artificially low and flooded the system with cash. All that money had to go somewhere, so it poured into every asset imaginable. Everything went up. But here's the problem. When everything is overvalued, there's nowhere safe to hide when the music stops. In 1929, if you had cash or government bonds, you could weather the storm. Today, even those so-called safe assets are looking questionable. Third, and this is the big one, the digital trap. This is what makes our situation fundamentally different from 1929. Back then, if you wanted your money, you walked into the bank and demanded cash. It was simple, direct. The bank either had it or it didn't. Today, your money is just ones and zeros in a computer system. And that system can be controlled, restricted, or shut down at the flip of a switch. We've already seen governments use capital controls during crises. In 2015, Greece limited ATM withdrawals to €60 a day. In 2013, Cyprus froze accounts and seized deposits. These were relatively small, isolated events. Now, imagine a global financial crisis where every government, at the same time, tries to prevent bank runs by implementing withdrawal limits. Imagine your banking app suddenly showing an error message. Imagine being told you can only access $500 a week from your own account, all for your protection. It can happen. It has happened. And the infrastructure to do it on a massive scale is already in place. Fourth, the shadow banking system. In 1929, banking was relatively straightforward. You had commercial banks and investment banks. Today, we have a shadow banking system worth over $200 trillion. These are institutions like money market funds, hedge funds, and private equity firms that act like banks but aren't regulated like them. The scary part? They're all interconnected in a web so complex that no single person understands the whole picture. When Lehman Brothers collapsed in 2008, it almost took the entire global financial system down with it because of how entangled everyone was. That was just one bank. Today, the connections are even deeper and more tangled. If one major institution fails, it could trigger a domino effect that moves at the speed of light through computer networks before anyone can even react. So you might be wondering, why 2026? What makes that year so special? The truth is, nobody can predict the exact timing of a financial collapse. Anyone who tells you they know the precise date is probably selling something. But there are cycles in economics that give us clues. Real estate cycles typically run about 18 to 20 years. The last major real estate crisis was 2008. That puts the next one right around 2026 to 2028. Debt cycles work the same way. When interest rates are low for a long time, debt piles up. Eventually, rates have to rise to fight inflation, and that's when the debt becomes unsustainable. We're in that rising rate environment right now. Plus, you have the political cycle. Financial crises often hit in the years after major elections, when new leaders have to deal with the problems they inherited. When you combine all these factors, 2026 starts to look very dangerous. But even if the year is off, the underlying problems are still there. The debt is real. The bubbles are real. The digital controls are real. The question isn't if another major crisis will happen. The question is WHEN and what it will look like. And that brings us to the modern bank run. This is where things get truly disturbing. In 1929, a bank run was a physical event. You could see the crowds outside the banks. The panic spread slowly, from city to city. It was chaotic, but it was human scale. In 2026, a bank run will happen at digital speed. Picture this. It's a Tuesday morning. You wake up, check your phone, and social media is on fire with rumors that a major bank is about to fail. Within minutes, Millions of people see the same information. You open your banking app, thinking about moving your money, but you hesitate for just a moment. In that single moment, 10 million other people are doing the exact same thing. They don't have to go anywhere, they just tap their screens. In less than an hour, the bank could lose 30% of its deposits. By the end of the day, it could be insolvent. We saw a preview of this in March 2023 with Silicon Valley Bank. It went from healthy to collapsed in less than 48 hours, the second largest bank failure in U.S. history. And it happened so fast, it shocked everyone. Now imagine that happening to multiple major banks at once. Imagine the government trying to calm everyone down while also restricting access to funds temporarily. That's a 2026 collapse. Digital, fast, and nearly impossible to escape once it starts. So why isn't this front page news? There's a reason most mainstream experts don't talk about these risks openly. It's an incentive problem. Banks don't want you to panic because panic becomes a self-fulfilling prophecy. Governments don't want you to panic because they need you to keep spending and investing. Financial advisors don't want you to panic because their fees depend on you keeping your money in the system. So instead, you get reassurance. You're told the system is resilient, that lessons were learned from 2008, that this time is different, but history tells us that every generation believes their financial system is invincible, right up until it isn't. The Romans believed their currency was eternal. It collapsed. The British believed the pound would reign forever. It was replaced. Americans believed housing prices only go up. Until they didn't. What makes us think our system is immune to the same forces that have toppled every other financial empire in history? Now, I'm not here to sell you gold or crypto. This is not financial advice. My goal is to make you think, to question, and to look at the patterns for yourself. If you're worried about your savings, there are things worth considering. First, diversification. It's basic, but it matters. Don't keep all your wealth in one bank or one asset class. Spread your risk. Second, liquidity. In a crisis, what matters is having assets you can use. That might mean keeping some physical cash on hand, not your life savings, but enough to cover essential expenses if digital systems go down. Third, education. Understanding how this system works is your best defense. The more you know, the better prepared you'll be to see the warning signs. And finally, community. In 1929, the people who survived best were those with strong local networks and skills to trade. Those same principles are more important than ever today. I know it's a lot to take in, but these are conversations we need to be having. Have you ever stopped to think about where your savings actually are? They're sitting in a system that's a lot more delicate than most of us realize. For decades, it seemed to work just fine, but right now it's buckling under the pressure of record-breaking debt over inflated asset prices, and a digital web so complex that a small glitch can snowball into a catastrophe in mere hours. Think back to the Great Crash of 1929. What did it teach us? It taught us that finance is built on one thing: confidence. The moment people lose faith that the system will protect them, the whole thing can crumble. No amount of government promises or regulations can stop a true crisis of confidence. And that's what makes the coming years, let's say 2026 for argument's sake, potentially even more precarious than 1929. Back then, a bank run meant people had to physically queue up outside a bank. There was a natural delay, a friction that slowed down the panic. Today, panic travels at the speed of light. A rumor tweeted out in the morning can trigger a full-blown crisis before you've even had your coffee. A digital bank run can happen with a few taps on a screen, involving billions of dollars in seconds. And here's the part that truly keeps me up at night. Most people will be completely blindsided. They'll wake up one day to find their accounts frozen, their savings inaccessible, and their entire financial future shattered. They'll be left wondering, how did this happen? Why didn't anyone warn us? But the warnings are here right now if you know where to look. They're in the staggering debt levels, the bubbles in real estate and stocks, the sheer complexity of our financial products, and the digital infrastructure that could be used to control our access to our own money. The real question is, are enough of us paying attention? I can't give you a specific date, whether it's 2026, 2027, or 2030. But what I can tell you is that the same fundamental forces that wrecked the economy in 1929 are gathering steam again. Only this time, they're supercharged by technology and leverage on a scale that would have been unimaginable a century ago. So my advice is simple. Start watching the signs. Question the official stories you hear. Prepare yourself, both mentally and financially, for potential disruptions. Remember, the people who make it through financial storms aren't always the ones with the most money. They're the ones who see the storm coming and adjust their course before the rest of the world even realizes it's raining. Your savings might feel trapped, but your awareness doesn't have to be. If this video made you think differently about your finances, please hit that subscribe button. We're going to keep diving into the hidden workings of the financial system that most people never see until it's just too late. I'm genuinely curious to hear your thoughts, so drop a comment below. Do you think a major crisis is on the horizon? Are you doing anything to prepare? Or do you believe the system is stronger than I'm suggesting? Let's discuss it. Thanks for watching.